All right, let's jump right into this explainer. Today, we've got a truly dramatic case study on our hands. And honestly, we're going to approach it a lot like an investigative medical autopsy. The patient on the table? UnitedHealth Group. We're talking about an absolute giant of a company that just suffered a massive, debilitating shock to its system, and its stock has absolutely tumbled. So we're going to dissect the data, really dig into the underlying financials, and figure out once and for all, is this patient bleeding out, or are we looking at the setup for a miraculous recovery?
Think of this as our diagnostic procedure. We'll start with the patient and the trauma, examine the integrated healthcare machine, and spot the red flags in contagion. Then, we'll check the vital signs, map out our bear, base, and bull scenarios, and finally, deliver the final prognosis. We need to know if this is a hidden gem or literally a ticking time bomb.
Okay, let's dive right into Section 1, the patient and the trauma. We're investigating a massive drop here.
55%. Let that sink in for a second. That represents the catastrophic collapse we've seen in UnitedHealth Group's stock price, falling from its all-time high all the way down to $406.57. And remember, we are not talking about some risky, highly speculative startup. No, this is the world's largest diversified healthcare company. A blue-chip giant taking a 55% haircut? That's a massive trauma, and it absolutely demands a thorough investigation.
Moving to Section 2. The integrated healthcare machine, and understanding the baseline moat. Before we can diagnose what went wrong, we've got to understand the baseline health.
So what makes this company historically so incredibly resilient? Well, it brilliantly illustrates this two-engine integrated model. On one side, you have UnitedHealthcare, the traditional insurance engine. We're talking about covering roughly 50 million Americans, collecting premiums, managing claims, and negotiating rates. But then on the other side, you've got Optum. Optum actually delivers the care. They manage over 1.6 billion, yes, with a B, pharmacy scripts every single year, and they crunch deep data analytics. Because the insurer is funding care delivered by its own providers, they get unbelievable cost and data advantages. I mean, historically, this machine has been practically unstoppable, driving 12% annualized revenue growth for 2 decades, and hitting a staggering $400 billion in revenue by 2024.
Now, what's really interesting is Section 3, red flags and contagion, the multifaceted crisis. Okay, so what actually infected the patient? There are a few immediate traumas currently attacking the business model. First, and honestly the most severe, there's an active Department of Justice criminal investigation into their Medicare billing and risk score upcoding practices. Never a good sign. Second, that massive Change Healthcare cyberattack, which slapped them with a painful $2.8 billion charge. Third, their medical cost ratios are running super hot, hitting between 89 and 89.5%. That's way above historical targets, basically meaning they're paying out way more in claims than usual. And finally, you throw in some abrupt CEO turnover and mounting political backlash, including renewed public debates around single-payer policies like Medicare for All, and well, the market is currently pricing all these intense regulatory and political risks straight into the stock.
And you can clearly see the symptoms of these traumas right in the financials. Look at these numbers for a second. The contrast here is just glaring. Top-line revenue, still climbing beautifully, moving from $324.2 billion in 2022 to over $400 billion in 2024. But then, look at the net income. It dropped from $22.4 billion in 2023 down to $14.4 billion in 2024. That cyberattack and those elevated medical costs are just eating away at the bottom line. So this sets up the ultimate debate for us. Is this just a temporary crisis? Or is this integrated healthcare machine actually entering a permanent structural decline?
Let's find out in Section 4. Checking the vital signs. We're looking at intrinsic value and cash flows here.
We literally need to put a stethoscope to the chest to see if the core is still pumping out value underneath all the bruising. Let's walk through these vital signs together. Take a look at the earnings per share. The reported GAAP EPS looks severely depressed at $13.25, but that's because of those one-time cyberattack and regulatory charges. The adjusted EPS, which kind of strips that noise away to show normal operating power, is actually $27.66. Then look at free cash flow, $20.7 billion in 2024. Guys, even in a crisis year, that is an incredibly robust flow of cash. This gives them an adjusted PE ratio of 14.7 and a PG ratio, which factors in price, earnings growth, and dividend yield of roughly 1.4. Now, for context, a PG under 1.5 for a company of this quality is actually modestly attractive. So what do these vital signs tell us? Basically, despite all the severe trauma, the patient is very much alive.
If we look at this through Peter Lynch's eyes, he would likely classify UnitedHealth right now as a stalwart with temporary problems. The framework here is that massive, structurally vital companies facing cyclical or non-structural disruptions can actually offer massive returns, provided, of course, that the disruption passes and earnings eventually normalize.
Adding to that, we can use Charlie Munger's perspective. Munger always wanted an excellent business at a fair price, right? Normally, UnitedHealth is an excellent business. But because of that severe DOJ regulatory uncertainty and the criminal probe, it gets temporarily demoted. It becomes a fair business at a fair price. So for you, what this really means is that if you're stepping in now, you absolutely must demand a strong margin of safety.
Let's move to Section 5 and see how this builds. Bear, base, and bull. Projecting the recovery.
Let's break down these 3 prognosis scenarios over the coming years. The bear case, that sees the stock plummeting further into the 195 to 240 range. That happens if the DOJ brings criminal charges that actually force a structural breakup of the company. On the complete flip side, the bull case projects a massive run to $700 or even $800 if the DOJ probe is dismissed and the Optum Care network rapidly accelerates. But the base case, and this is where the data really points us, targets $485 to $560 over 3 to 5 years. This assumes the civil settlement with the DOJ and that those high medical care margins heal up. This base case essentially implies the market today is over-discounting temporary earnings disruptions, treating them like permanent structural damage.
Which brings us to Section 6, the final prognosis. Let's get into the actionable takeaway. So, the crucial point is, what do we actually do with this diagnosis? Here are the exact steps for a disciplined entry strategy framework. Number 1, wait for some resolution from the DOJ. We want to see a civil settlement over a catastrophic criminal one. Number 2, watch that medical care ratio. You need to ensure it falls below 87% for 2 consecutive quarters just to prove those margins are actually healing. And number 3, target an entry price of $340 to $370 for an optimal margin of safety. Why that specific price? Well, at the current $406.57 mark, you're only looking at roughly an 8% annualized return over the long haul. Disciplined buyers demanding a proper margin of safety really should wait for a pullback to hit a target return of 9% or higher.
So the million-dollar question on the table, at $406.57, is this a buy, a hold, or a sell? Based on our autopsy today, the verdict is a conditional hold or a highly selective buy. If you're a risk-tolerant value investor, the data suggests keeping any position sizes very small, like 3 to 5% of your portfolio, until that intense fog around the DOJ investigation clears up. The patient is stable, but make no mistake, they are still in the ICU.
Which leaves us with this final thought. When we look back 10 years from now, will UnitedHealth Group's 55% collapse be remembered as a massive value trap where investors tried catching a falling knife? Or will it be seen as the generational buying opportunity of the decade? The vital signs are strong, but the trauma is very real. Keep digging into the data, keep refining your frameworks, and keep learning. Thanks for joining me for this explainer, and I'll catch you in the next one.